Welcome to Florida's Cannabis News Podcast, a weekly podcast exploring the legal, political, and economic changes to Florida's cannabis industry, covering important news and events for Florida cannabis businesses and professionals. Sit back and relax. Florida's Cannabis News Podcast begins now.
Hey everybody, today is November 21st, 2020, and this is David, your host here at Florida's Cannabis News Podcast. I hope you had a great week and are flying into the weekend. We are getting some sun. I'm looking outside my window right now. The terrible weather here in South Florida has been a pretty big bummer, so I'm happy things are clearing up so we can get back out into the sun and enjoying our great state. We are getting a nice little cold front though, so I'm enjoying that, throwing on the long sleeve at night, and I really like that. I do want to make a personal announcement before we get into today's show. Yesterday, I found out that I've passed the Florida bar exam. I am officially a licensed attorney here in the state of Florida. Now, I do not practice cannabis law. I do have a job, and it's not in the industry, but I have this podcast because this is truly my passion. I enjoy this industry. I think the plant itself and the medicine, the medicinal value it provides is a great alternative to opioids and big pharma. So that's why I come on here every week and try to normalize the issues and try to educate everybody here who listens to the podcast about the benefits of medicinal marijuana. And when I say medicinal marijuana, I don't necessarily mean medical marijuana as in like we're only talking about medical marijuana. Cannabis in general, there's medicinal benefits whether you regulate it as adult use or as a medicinal product. So yeah, I'm just very happy about that. I'm looking forward to starting my job on Monday. But again, do not practice in this area. None of what I say on the podcast should be taken as legal advice. This is just my passion, and I'm happy to come on here every week and talk about the issues. Another housekeeping item, international listeners, I'm still so pumped you guys listen to the podcast. I think it's amazing. Keep it up. This is really cool watching the podcast grow and stick in different areas of the world. So thank you so much for keeping up with the news here in Florida. I've also been getting a bunch of requests to talk about certain topics on Twitter. So listeners, if there's a topic of law or a news story or an issue in the industry that we have not hashed out on the podcast, just shoot me a tweet, send me an email, david@floridacannabispod.com, and I will get it on I'll add it to the segment list. Right now on deck, we have hemp. Some people want us to talk about hemp. People want us to talk about the difference between orals and edibles under Florida law. So we're going to go and dive into those statutes in a few episodes down the road and talk about that. I also want to talk a lot about employment law and cannabis in the workplace and what that looks like in the United States. So yeah, lots to look forward to. I'm very excited. So today we are continuing with our 5-part series on cannabis taxation. This episode is part 4 out of 5, so we're one more away. But before we get into the thick of things, I want to bring your attention to an article I came across over the weekend that is about 280E. So we know there are state taxes and federal taxes. 280E is a federal tax law, so cannabis operators not only file state income tax, but they file federal taxes on top of that as well. But I came across a news article out of New Jersey where the New Jersey Society of CPAs, Certified Public Accountants, they're making some noise about 280E. Now, operators in New Jersey obviously have to abide by 280E because no matter what state you're in, you have to abide by federal tax law. But what's interesting about New Jersey's market is they actually incorporate the same provision of 280E, not allowing ordinary business expenses to be deducted from businesses, into their state's tax law. So operators in New Jersey, I feel your pain. But the New Jersey Society of CPAs, they're calling on the state to decouple from the section of the code in their state law. Again, their goal here is to remove themselves from 280E because it would cut costs for operators by a lot, as we have discussed in parts 1 through 3. Decoupling themselves from 280E would open up the business to entrepreneurs, smaller businesses, and minorities and women who are interested in joining in the industry. These are groups who are typically underrepresented in the cannabis industry. So under the CPA's proposal, a business in New Jersey would still be subject to 280E, but under state law, the operators would be able to take deductions against their state taxable income. I went ahead and found a copy of the letter the New Jersey Society of CPAs wrote to the New Jersey legislator. So just kind of breaking down the details of this letter, I will do for you right here. Right off the bat, it appears the letter is making rounds in the state legislature and has actually garnered some significant interest. Now, the main argument for changing the tax law is not only because 280E is outdated and crippling the industry, as we learned in Part 3, but the CPAs are making the argument that the current well-established players in the cannabis industry, we know, the big multi-state operators, they have resources to deal with 280E, which is actually the topic of today's episode. And if the state does not do something now to alleviate the pressure 280E puts on its businesses, locally owned New Jersey businesses will be outclassed, and the New Jersey market will end up being home to more nationally based brands, some of the big boys who have already established their foothold in the industry, rather than supporting smaller businesses or New Jersey homegrown brands. These bigger, larger corporations, these bigger, larger operators generally have enough cash on hand and significant legal teams to withstand the drain 280E places on their profits, but smaller startups often do not. And especially in the first few years of a business, the business is trying to get off the ground. I don't know if some of you listeners have tried to start a business before, but the first few years are typically the hardest and costliest years for a business. So 280E could literally kill New Jersey cannabis businesses from the get. Now, part of the CPA's argument, continuing on with the letter, is that because New Jersey just recently legalized the plant for adult use on election night, yes, New Jersey was one of the 5 states that reformed their cannabis laws on election night. Because they did this, New Jersey should decouple itself from 280E because at the state level, the plant is legalized. At the state level, it's not a controlled substance yet, or it's not a controlled substance at all. Now, kind of expanding the scope to the national level, 2 of the 10 states with an adult use market have actually decoupled completely from 280E, Colorado and Oregon. So New Jersey would kind of be piggybacking off of what those 2 states have done. I will link to the letter in the show notes if you want to read more about the CPA's arguments. I think it's definitely worth the read. Shouldn't take that long. And another tidbit of news I picked up this week, TruLeaf CEO Kim Rivers was on the news this week talking about TruLeaf. And in part 3, we talked a lot about how cannabis operators are currently dealing with 280E. Listen to what she said about the rule.
Joining us now is the CEO of TruLeaf, Kim Rivers. Kim, welcome back to the show.
Thanks for joining us. These are great numbers, and you talk about that growth, and TruLeaf is referred to as the gold standard in terms of profitability in the industry. And so help us understand just how sustainable this growth is. As someone that's been investing in the industry for a long time, I think we're only just getting to both the addressable market, et cetera. But talk about profitability and talk about the operational leverage in your business as one of the leaders. There's a handful of leaders that seem like they're moving ahead of the pack. And how far ahead of the pack are you? There's a few questions in there, but address those if you can.
Sure. Well, in terms of the overall opportunity, like I said, we're seeing really a sentiment change across the country, which is going to lead to changes from a regulatory perspective, which, of course, is a key driver as additional states open up. And then, of course, as those states continue to expand their programs. I mean, Pew Research poll in 2019, 91% of Americans are in favor of some form of cannabis. And so, again, certainly we think that macro opportunity is certainly there. When you talk about TruLeaf in our business, we have to be extremely financially disciplined in this industry. As we know, Tim, we are taxed under 280E, which is a significantly higher tax rate. It's approximately 50% tax rate. To put it in perspective, year to date, Trulieve has paid approximately $71 million in taxes. In a normal business or in any other type of business, we would have paid we would have saved approximately $40 million. Why that's important and why we have to watch every single dollar is the fact that our cost of capital is also significantly higher. As we know, we aren't able to fully uplist in the U.S. And so and our rates, in terms of what I'll call them cannabis rates, are significantly more expensive. We don't have access to regular banking. So we are literally in this industry plowing ahead with 50% EBITDA margins and, again, high level of growth and revenue production with one arm. Sometimes it feels like two arms tied behind our back. So you can just imagine the opportunity and the growth opportunity in this sector if we were just able to operate like a normal business and that if the handcuffs were taken off.
So yeah, I thought that was fascinating to hear right from the source herself about how her company, a big multi-state operator in our cannabis industry, is dealing with 280E. So we could see how the effects, the CEOs and these companies are truly feeling the effects. Okay, so back to our regularly scheduled programming. Today we are transitioning the conversation into how cannabis operators today live alongside Section 280E. We're going to break down basically how and what are cannabis operators in the United States doing to survive while 280E is not allowing them to deduct ordinary business expenses when filing their federal income tax. Now, at a high level, this episode breaks down into two arguments. Number one, the second line of business argument, and two, stuffing as many expenses into COGS, cost of goods sold, as the businesses can. In this episode, we are going to use a few U.S. tax court cases to show how each argument works at the legal level, and we're going to poke holes in each argument to show you their downfalls and where cannabis operators slip up in regard to avoiding the burdens of 280E. This is a very informative episode because we are using real-life court cases and real-life companies and real-life examples to better understand how 280E works and how cannabis operators are avoiding the rule. And surviving every day in this industry. I hope you enjoyed today's episode. I know I will. And let's dive right into it. We know Section 280E is crippling the United States cannabis market from developing. Without tax deductions available to mainstream businesses, cannabis businesses, they can't mature, thus leaving patient and adult use consumers having to resort to the illicit market. Congress should amend Section 280E for three reasons. First, Section 280E negatively impacts business owners, patients, and consumers. Businesses struggle to stay afloat, patients in rural areas lack access to medicine, and adult consumers are forced to purchase unregulated cannabis from the illicit market. Second, the social context in which Section 280E was enacted has changed. The sale of medicinal or adult use cannabis in the United States is a legitimate industry that employs over 200,000 people full-time. By comparison, over 100,000 people work in the textile manufacturing industry, and over 50,000 work in coal mining in the United States. And third, the IRS uses Section 280E to punish legitimate businesses, which is not the intent of Section 280E. States are recognizing cannabis as a legitimate business, and lawmakers are thwarting the United States' ability to compete in the global market because they have not provided a level playing field for the U.S. cannabis companies to develop. The most effective way to help business owners stay afloat and give patients and consumers access to safe medicine is through legislative action. Lawmakers have taken inconsequential steps to address this problem. Even though Congress did the most significant tax overhaul of the code since 1986, when they signed the 2017 Tax Cuts and Jobs Act into law, this act did not repeal Section 280E or even amend it. Despite these hurdles, the current legal landscape provides creative avenues for cannabis businesses to alleviate their tax burden. Now, the two most successful methods of cannabis business owners that they use to maneuver around Section 280E are first, the second line of business argument, and second, accounting as many costs as possible into the cost of goods sold section of the business's tax return. Now, first, let's break down the second line of business argument. Under the second line of business argument, a cannabis business owner argues that it is engaged in essentially two trades or businesses. Thus, Section 280E should only apply to the line of business where cannabis is trafficked. Now, in 2007, Californians helping to alleviate medical problems, CHAMP, that's what they'll call them, they raised this exact argument. CHAMP was a nonprofit medical cannabis community center whose members had debilitating diseases. They operated on paper with a dual purpose. Its primary purpose was to provide caregiving services to its members, and its secondary purpose was to provide medical cannabis in compliance with California law. Now, in providing the caregiving services, CHAMP offered field trips, social events, educational classes, and distributed food and hygiene supplies. CHAMP argued that its business expenses for its caregiving services should not be subject to Section 280E because the expenses were separate and apart from the petitioner's supplying of medical cannabis. The U.S. Tax Court actually agreed, and they held that CHAMP could not deduct business expenses for supplying cannabis, but could deduct business expenses associated with the caregiving services. The court, after considering, quote, the degree of economic interrelationships between the two undertakings, that CHAMP was involved in more than one business. The court did not apply Section 280E to the part of the business where CHAMP provided caregiving services because the caregiving services were substantially different from CHAMP's distribution of medicinal cannabis. CHAMP could deduct the business expenses related to the caregiving services because these expenses related to the separate caregiving services, which are justified under Section 162. But despite a victory in this case, the U.S. Tax Court rarely accepts the second line of business argument. Check this out. In contrast, in 2012, Martin Olive, an owner of a medical cannabis dispensary in California, unsuccessfully argued that his company operated two separate businesses. Similar to CHAMP, Mr. Olive argued that he should be allowed to deduct business expenses associated with his business's caregiving services. But in this case, the tax court disagreed and held Olive could not deduct expenses from his caregiving services. Using the degree of organizational and economic interrelationship of the business, that test, the court used that to determine the parameters of his business. And in this case, the court actually distinguishes Mr. Olive's business from the business of CHAMP, even though they're two separate cases. Now, the primary purpose of Mr. Olive's medical cannabis dispensary was the retail sale of cannabis under California's medical cannabis law. The business provided minimal activities and services, which is different from CHAMP. Now, the differences between both companies was stark. Mr. Olive's business did not separate its dispensing of medical cannabis with its caregiving services, whereas 72% of CHAMP employees worked in the caregiving business and provided its caregiving services regularly, extensively, and substantially independent of providing medical cannabis. CHAMP rented space at a church for peer group meetings and yoga classes, and the church did not allow cannabis on the church's premises. All of Olive's employees worked in the cannabis business and regularly sold and helped patients consume cannabis on site. Mr. Olive's business also had a single bookkeeper and accounted for all of its business dealings, thus proving that the business was truly a single entity. Both the Olive and Champ case establish that the tax court will hold a cannabis business to a strict standard in establishing that it offers multiple line of businesses, which is why it's so hard to win on the second line of business argument, but I'm just trying to show you that this legal argument does exist. Champ and Olive are the current templates in determining whether a business expense is deductible under Section 280E. A cannabis business can deduct business expenses related to a separate trade or business that does not involve trafficking of cannabis, but the U.S. tax court has reaffirmed its strict standard when analyzing this argument in numerous cannabis cases since Olive. A couple you should go look out for is Champ versus Commissioner in 2007. You should also see Beck versus Commissioner, which is a 2015 case. In that case, they disallowed deductions under the second line of business argument because the petitioner in that case did not sell any non-cannabis related items or services. Also, another case in 2015, Canacare Inc. versus Commissioner. In that case, the court held that the petitioner was a single medical cannabis dispensary because even though it received income from non-cannabis related items like books and t-shirts, all income derived was incident to its cannabis business. And another case, if you're really trying to nerd out, in 2018, Alterman versus Commissioner. In that case, the court held that under the degree of this test they're using, the economic interrelationship between the two activities, a Colorado medical cannabis business, the petitioner in this case, the court held was a single entity because their non-cannabis products, which were pipes and papers, merely complemented its efforts to sell cannabis. I mean, there's so many good cases here. There's so much good case law. Another, not good in terms of for the business owners, but just great to read. There's another famous case, Harborside in 2018. The court held that Harborside had a single trader business because Harborside dedicated the lion's share of its resources to selling cannabis and cannabis products, which sales accounted for over 99% of its revenue. Reading Olive and Champ together, good works or community involvement are not sufficient by themselves to support a tax deduction outside the application of 280E. In order to be deductible, this non-cannabis activity must be considered a separate trade or business entered into with a motive to realize profit. If a cannabis business owner is to have any hope of wielding the second line of business argument, they must be prepared to show that the alternate business line is extensive enough to stand on its own without the cannabis part of the business. Reading the case law, a court is more likely to accept a separate business activity if the business owner shows that business line would be viable even in the absence of sale of cannabis. If the business owner asserts it has a second line of business, they should treat it like a second line of business, accounting separately for its income and expenses so that if the IRS or tax courts are kind enough to agree with you, the amount of deductible expenses are readily available. Now, the other way cannabis businesses are getting around Section 280E is allocating expenses as costs of goods sold. Now, while on its face, Section 280E disallows cannabis businesses the deduction of all business expenses, business owners have used cost of goods sold to their advantage. Now, cost of goods sold, we'll call it COGS, those are the costs of acquiring inventory through purchase or production, including shipping costs and directly related expenses. Taxpayers, regardless of what business they're in, use this formula to calculate gross income. Gross receipts minus COGS. Now, Congress did not disallow COGS deductions in 280E because it feared possible constitutional challenges to the law, and we could see this in a case, Eisner versus Macomber. Here, they denied deduction for COGS because they thought that the affected business to be taxed on an amount in excess of his income would go beyond the 16th Amendment. We also have basically a bunch of constitutional arguments arguing that if they disallowed COGS, it would be a violation of the Constitution. So the IRS and the U.S. tax courts permitted cannabis retailers to deduct their COGS because of a historical view that COGS are a component of gross income and not a deduction by themselves. Some would argue this is actually a pro-cannabis business tax provision because it allows the business owner to recover some, though not all, of their business expenses. Now, while this argument is valid at the macro level, this is only a small triumph because the majority of business expenses are not deductible under COGS. Not only are COGS a minor part of cannabis business expense, the IRS employs the COGS exception more narrowly to cannabis businesses compared to businesses in mainstream industries. The IRS prohibits cannabis businesses from using revisions to the code that were enacted after Section 280E went into effect. So in 2015, the IRS, they released an internal legal memo outlining a strict interpretation of Section 280E when applied to cannabis businesses. Though this memo may not be used or cited by taxpayers as legal precedent, saying that it holds weight in court, the memo does outline how some IRS officials analyze Section 280E and how they determine COGS. This prohibition forces cannabis businesses to use outdated versions of the code, which is unfair because other businesses, including other illegal ones, use updated taxpayer-friendly accounting laws. Now, when calculating COGS, cannabis businesses are forced to use Section 471 of the code. Section 471, which was in place when Congress enacted 280E, instructs retailers to calculate their COGS as any direct costs they pay for inventory, the invoice price of goods, plus any transportation or any other necessary charges in acquiring possession of the goods. So cultivators, under Section 471, they must include both direct and indirect costs of creating their inventory in their COGS calculation. Now check this out. Section 263A, which was enacted 4 years after 280E was enacted, expanded to 471. Section 263A broadened the definition of indirect costs and gave retailers the ability to include indirect inventory expenses in their COGS. Section 263A allows businesses to capitalize on indirect costs. So some of these examples are administrative and inventory costs, as well as the amount paid in state excise taxes, and they could deduct them under COGS. The goal of this expansion of 471 was to treat taxpayers more fairly, but U.S. tax courts are not willing to allow cannabis businesses to use Section 263A. Now, under the 2015 IRS memo I mentioned before, cannabis businesses are required to calculate COGS deductions using the regulations under 471, and not the new accounting methods other businesses have access to under 263A. Isn't that crazy? The memorandum outlines a very narrow reading of the costs included in COGS because it suggests the IRS will not allow cannabis businesses to allocate those indirect costs, such as purchasing, handling, storage, into COGS. Now, other than this memo, the IRS has not offered much guidance regarding the application of Section 280E. Now, there's a big gap in understanding, and with this gap, it's up to the courts to outline the fairly narrow parameters of 280E. Now, this issue was the focus of an important case, Patients Mutt Assistance Collective Corp versus Commissioner. Now here the petitioner was Harborside, which arguably is the most famous medical cannabis dispensary at one point in the United States. They've been in battle with the IRS since 2010 over a $36 million tax bill. From 2007 to 2012, Harborside calculated their COGS deductions using 263A of the code. The IRS argued that Harborside had to calculate their COGS using Section 471. Remember, the outdated part. The tax court held Harborside could not use Section 263A because that section did not apply to drug traffickers under federal law. And because federal law labels Harborside as a drug trafficker, Harborside must calculate under 471, that is, calculate their costs of goods sold under 471, which does not include the indirect business expenses. In this case, the court concluded that Harborside was a reseller, not a producer. Now, this conclusion is important because Section 471 rules because Section 471 rules, those rules that apply to resellers, do not allow for extensive indirect costs to be included in inventory that the Section 263A rules do. This holding, that the more expansive Section 263A does not apply to businesses subject to 280E, is not favorable to cannabis businesses whatsoever. But the holding does provide cannabis business owners much needed guidance regarding 263A's interaction with Section 280E when calculating COGS. Here's the conclusion you could take from this case. Resellers face significant challenges by the IRS if they include indirect costs in inventory. But still, cultivators and producers must carefully consider how Section 471 applies to their business, depending on their business's activities. Now, Harborside was left with two options. They could pay their tax bill or appeal to the U.S. Court of Appeals for the Ninth Circuit. Given the amount of money at stake, I'm not sure what the update of the case is, but Harborside should definitely appeal to the Ninth Circuit. I think there's a respectable chance Harborside could win on appeal because Harborside is not trying to reverse any finding of fact by the lower court, which is a high standard to meet. Rather, Harborside would appeal the legal application of Section 263A. The tax court hinted there might be some relief when it stated that the overlap between Section 280E and 263 created a confusing legal environment. The Ninth Circuit could be more sympathetic to Harborside, but I think based on my research, Harborside has yet to appeal. Although the Harborside case did not set legal precedent, the holding opened a new avenue for cannabis businesses to consider when calculating their COGS. Permitting cannabis businesses to use Section 471 forces cannabis businesses to use savvy accounting methods to try and fit more of their expenses into COGS in order to avoid the lack of deduction opportunities under Section 280E. This puts state legal cannabis businesses in a peculiar position. Generally, a taxpayer would prefer to deduct an expense in real time rather than capitalizing it through COGS. Why? This is because a current deduction immediately reduces tax liability, whereas capitalizing the expense delays any deduction until the goods are actually sold. Thus, the state legal cannabis businesses, they're forced to throw everything they can into COGS. This approach is risky and can lead to severe consequences. Harborside's tax bill is just one example. Now, we have to ask the question, will cannabis businesses be treated fairly one day? Maybe. There are arguments that have not been made. For example, the argument that the congressional intent behind Section 280E has not been met. It wasn't until 2015 when the courts first started to consider the congressional intent of Section 280E itself and whether applying Section 280E to state legal businesses aligned with that intent, which it does not. In an appeal of the 2012 Olive decision, Olive argued that the application of 280E to cannabis businesses did not align with the intent of Section 280E itself, which we know, as seen in Part 1, 2, and 3, that intent was to deter illegal drug use. The Ninth Circuit Court of Appeal was not persuaded by Olive's argument, even though I think it was a strong one, and reaffirmed the tax court's decision. Written law governs tax enforcement. Yet the U.S. Tax Court and the U.S. Supreme Court have always interpreted this text of a statute to some degree of interpretation not included in the text. They always, in interpreting what the text means, not necessarily the judges who are originalists, but the other judges, there's always some sort of extra meaning behind the text. They'll look at the Senate reports, the House reports, the political climate of the country at the time to decide what did they mean, what did our government mean when they enacted the statute. The Supreme Court usually interprets the code to carry out its legislative purpose. Thus, reading beyond the plain meaning of the text of the tax code, when the language and suggested purpose of the code conflict, the Supreme Court is willing to interpret the code to align more closely to the provision's purpose, rather than a straight-up literal reading of the provision. Now, the legislative history of 280E suggests that drafters envisioned 280E to deter illegal drug trafficking, not to cripple legal United States businesses. When reading the code on its face, Section 280E seeks to deter illegal drug use, but when it's applied, Section 280E has little connection with the original intent of the rule. Revising Section 280E would advance Congress's intent to deter illegal drug dealing because a revision of the code and alleviating our current legal cannabis businesses from this draconian rule would help the legal and regulated market compete with the illicit market. Revising Section 280E would also restore fundamental fairness by assessing income tax on income for all businesses legal under state law. The legal strategies that we discussed here in Part 4, operating a second line of business and trying to use savvy accounting methods to put expenses into COGS, they've proven to work, but they've created no lasting impact on the industry. In my opinion, it appears it's going to take legislative action to fix this problem that is 280E. Congress, in my opinion, should modernize the rule to better align with the drafter's intent to deter illegal drug use and to better align with today's legal cannabis industry. Okay, so you just listened to part 4 of 5 on Florida's Cannabis News podcast, 5-part series on Section 280E. I love getting into the nitty-gritty of the legal arguments presented by the U.S. cannabis operators, and I'm looking forward to seeing what kind of reforms we can see in the future in regard to this rule. And that's what we'll tackle in Part 5 next week. If you think I do a decent job of breaking down the laws, analyzing cannabis news, and talking about current events, consider rating the show, leaving a review in your podcast app, and subscribing, and also sharing with your friends who might be interested. I also recommend visiting our website, floridacannabispod.com, and signing up for our free newsletter. Here, I will send episodes directly to your inbox, no spam, no junk mail, anything like that. Just here's a link to the episode. And also on the website, check out our shop. We've had a few, I put up some Amazon links, so you can purchase Amazon products through our shop, and a little bit comes back to the show. This will help us buy audio equipment, keep the lights on, and do more research, spend more time expanding and diving into what we love to talk about, and that is Florida's cannabis industry. I put some products on the shop that I think you could be interested in. So yeah, go check that out. And thank you for listening to Florida's Cannabis News Podcast. We will see you next week.